Welcome back to Good Returns. I'm Matt here with Garrett, and we're going to be transparent with you right from the start. We're prepared for this episode based on a week where we had a ceasefire framework announced, some signatures applied to electronic paper. Oil fell 13.
No, you did that in person, didn't you?
13%. Well, it was like they sign and then they scan and they sign. It's like old school DocuSign. Oil fell 13%. Kevin Warsh held his first Fed press conference, and SpaceX completed the largest IPO in history. And this morning, situation in the Middle East, it's going to keep us on our toes. Let's just say that.
It paused. I'll help you with that. There was a little bit of a pause, the ceasefire framework that drove largely a big movement for oil. Oil has been moving, as we know. We've talked about it every week. But you've got Israel continuing to bomb and attack parts of Lebanon, which Iran feels is against the framework. And so they're stepping back from the negotiations. This is like you said, recent development. This is we genuinely don't know where it goes at this point.
Yeah, in some context, of course, there is, and this is why you have to be careful with headlines and everybody trying to, be their own Henry Kissinger at home with trying to figure out what is and is not happening and what will or will not materialize from said happenings. So you had some is negotiations paused? Is it not? The ships are flowing unimpeded. That's the reality of the situation. Today, oil is up 67 cents on the barrel. So what is that? 0.70%, 0.60%, something like that. So there's some context. Today is a market holiday. There is no stock trading, but commodities are in fact trading. So we can see the price changes of those, but the U.S. stock and bond market is closed. So we had a short trading week this week. The numbers you're seeing this week are locked in. They reflect the ceasefire announcement, the pricing of that in, and of course, nothing happening today except for what we can see traded in commodities, which is oil, which you would kind of think would be the most important thing to pay attention to anyway right now as it concerns these discussions. So we'll see how things happen over the weekend, what happens Monday, or doesn't happen Monday. There's a real possibility that by Monday everybody forgets about.
Yeah, that is a very
whether or not one group started talking to another group somewhere in Switzerland, which I guess it's nice over there this time of year. I don't know. You would think shouldn't be cold.
Should borrow a flight and go check it out.
Do you have the business card?
No, I didn't. Oh, you know what? Oh, it's gone. So we're going to cover this week as it unfolded, as it stands this morning, and we're going to get into a Federal Reserve conversation that happened with the new incoming Fed chair, Kevin Warsh. Planning room, we'll talk about relevant topics there, IPOs and things of that nature. But Middle East story, new chapter this morning, and we'll be as honest about it as we can with as much data as we have. But, we're not here to introduce news to people, but it is important in the context of what the markets seem to be adjusting to over the week.
Quick note before we get into that, everything on the Good Returns podcast, and if you're watching on YouTube, is for educational purposes only. Nothing we say should be construed as personalized financial advice for your situation. We're here to give you context and help you think more clearly. If you don't have a financial planner, a financial advisor, portfolio manager, we always encourage you to seek a trusted advisor. You can do so by going to momentumwealth.us. Feel free to shoot us a text. Any number you see, you can text, you can call, you can also email, and we'll be more than happy to have a real high-level discussion with you about your situation and see if we can add value to it. Well, let's get after it. Quick numbers: S&P up 1.4% for the week, NASDAQ 3.1%. Equal weight S&P was a little bit up, call it flat. Technology led across all sectors, big shocker, 4.4%. Industrials were up second, 3.2%. Energy was the clear laggard, down nearly 6%, as oil dropped sharply on the ceasefire framework. And I would say last week, I said it wouldn't surprise me, end of summer, we're in the 70s. 7 short days later, we're in the 70s. So very interesting. I would say, though, that we did, as the week started to come to a close, again, short trading week. So I'm applying a little more weight to this maybe than it's worth, but because it's a short trading week, it seems important. We had a really strong day of your industrials and of your equal weight outperformance on one day. That was a pretty powerful disconnect between the tech and the industrials. Very interesting.
That will come into play a little bit later when we talk about some things the Federal Reserve may be looking at. Industrials will kind of rear its head again, kind of spoiler there. But bonds, you have roughly flat for the week. One exception there were the long maturity bonds, meaning the longer term bonds that outperformed as falling oil prices eased inflation concerns and pulled yields lower toward the long end. Dollar strengthening a little bit, Bitcoin continuing to trade lower, but also some really constructive things happening under the surface of Bitcoin specifically. So it did trade a little bit lower, but you did see it rebound. I don't know what it's at today, but
yeah, it's very interesting for sure. Now on the rolling week, oil is down 13%. So we're back in the mid 70s, as I said, the lowest since early March. The announcement of the memorandum of understanding between the U.S. and Iran did, in fact, drive that MOU. And as we said, kind of leading into the show today, the framework, how all this plays out, nobody knows. But you can see our commentary since all this began has been very clear-eyed. The trajectory of the price of a lot of these things is a foregone conclusion. There's going to be bumps along the way. Same thing we've talked about with interest rates. So again, very interesting to see how all this is playing out, but we'll get into it. And there's some more stories too. I don't know where you want to lead off first. I'll let you choose today with kind of the topics. What are the big topics? We have a handful here.
Yeah, we only have a few today, or this week rather. We can kind of continuation of the ceasefire framework that we talked about. They announced that framework to end, or as you said, the memorandum of understanding, I guess, is the name for it, which is kind of funny. But announced the framework to end the conflict and reopen the strait. Like you said, oil fell back in the mid-70s. This is the thesis that you've been holding for a long time about looking out past the noise that happens in the short term, which is going to happen, which uncertainty produces volatility in the market. We always talk about volatility being to the upside and to the downside. In this instance, it was to the downside and the upside sometimes. You had kind of muddied waters there, but strait eventually reopens, oil falls, inflation concerns largely disappear. That's sort of been your story for the past, I can't even count.
Well, it's you have to think about the supply demand dynamics of commodities, especially commodities that are accessible over large parts of the earth. And I've mentioned Venezuela so many times because they have the largest proven oil reserves. Now, interesting because the Gulf countries, Saudi Arabia, the UAE, Iraq, Kuwait, they have their stated proven oil reserves, which Venezuela has more than like a couple of them combined. But interestingly enough, even though they suck that stuff out of the ground at such a rapid pace, their oil reserve numbers never drop. So do they have more than they state? Probably. But, Venezuela has a lot of proven oil reserves. So when you have something that can be accessed pretty much across the globe in enormous quantities, you have technological advancements that are reducing the need and or price shock per unit of GDP across the world per unit that's used. Every time there's a price shock, you use less of it per unit of GDP permanently. Anytime you have that, these things tend to solve the problems even if the issues aren't resolved. I'll give you an example. I have gutters on my house. Bet you didn't see that coming, did you?
I never see anything.
Right. We did that almost at this. You did it before I did because after we finished building the houses, you're trying to get the furniture in and all this other stuff. And it's like, oh man, I need gutters. And so I had gutters put in. That helped great. But I had this one little spot where a pretty significant amount of the roof line would go. And one of the spouts would hit. I could not get the water to flow where I wanted it to. It just couldn't. It was an improvement, but it kept where it would come onto the back porch and you have some water stand up. And then over time on the concrete, it gets kind of greenish algae. So about 2 weeks ago, I was like, I'm tired of this. So went in and Home Depot and I ordered this thing you put in the ground and then you put a pipe to it. And I needed to get another pipe. It's like a 12-foot pipe. I need another 12-foot. And then it's this thing that pops up out of the ground. So the water goes in and then goes down the pipe and then pops up further off into the yard. Issue solved, right? The water's still flowing, but I have permanently altered its course because I had a problem. I had a problem that the water was pooling up in a spot that I didn't want it to. And eventually I got so tired of it that I decided to redirect that water somewhere else. So something that's been happening through the midst of all of this talk back and forth is the Europeans, along with their Gulf partners, are systematically and daily creating permanent alternatives to using the Strait of Hormuz. So it really doesn't matter what is said or what happens. That the most amount of oil that flowed through that strait, it was the day before all this started. It will never get to be that much again because they're redirecting it, just like I redirected, right? The water's still going, but it's going to a better place. I don't have to worry about issues and scrubbing algae off the little corner of the porch. That's what's going to happen. So in a point, it kind of, which has been my commentary this whole time, is that these are short-term issues and it's going to solve itself, and it doesn't really matter what happens specifically because, you know, there is an incentive for something like this to not affect, you know, the UAE, the Saudis, the Iraqis, the Kuwaitis ever again. They have incentive, significant incentive, and they're in lockstep moving, and the Europeans are helping them do so.
Yeah, I mean, I think the reason that it comes up so much in this particular podcast is because we're talking about investors and we're talking about volatility, and we're talking about the way that it has an effect on the market in real time. Whereas, you know, all of those things can be true at once. The price of oil is over a long term on a downtrend. And, you know, I don't want to look at my account balance this week. Both of those things can be true because you're in this moment in time, and it's hard to see sometimes out into the future. But it's important to keep that long-term focus and not let these short-term kind of bursts rattle the cages or change your plan or have you reconsidering anything. If you're reconsidering your plan based on short-term movements, it's probably not a good plan to begin with. It probably needs some shoring up somewhere. And so it really is an opportunity to kind of come in and say, hey, you know, does this short-term volatility really kind of concern me in a way that makes me want to look out farther than that and make sure that my longer-term plan is not changed or affected in any way by these short-term movements, which can happen a lot. Yeah. And we've seen that. It has happened a lot.
Well, and I guess we can transition, if you'd like, to the Warsh's first press conference, because I think what you said is going to really be very pertinent to this discussion, because before we have talked about the importance of tuning out the noise, and I think we're entering a market regime, potentially a long-lasting market regime for at least a decade, to where you're purposefully not going to be getting noise to tune out. And we'll talk about what I mean by that. And there's two elements to that.
To a certain point, I think that's correct. But we live in a culture where the noise is constant. So you talk about changing the flow of things. You changing the flow slightly of information in this respect, not oil or water, but information is not necessarily going to stop noise in other parts of the landscape. Meaning media narratives. For those, so you're still going to hear the talking heads. You're still going to see the headlines. You're still going to see all that kind of stuff. But with noise, and that's the noise that we're mostly talking about.
Our listeners and people paying attention are going to know. They're going to begin to see a stark difference in how those headlines are presented, because they will be without the context that has driven so much personal investment mistakes over the last decade. And we'll get into that. But unless you want to continue to talk about oil,
no, I think we've. Okay. I don't want to beat a dead horse, which I feel like we've done.
So, well, we'll go to the Fed, and I did want to. We talked about this before. I did want to spend some time on this because I think that there's some pretty consequential changes in how markets are going to operate going forward. If you're on our marketing email list, if you have not yet made the decision to be a client of the firm, I sent out several messages about the changes that are going to be happening and how some people's investment playbooks are going to be permanently changed. Now, it's going to be permanently changed for the good, to the upside. and people really haven't fully absorbed it. I watched the press conference intently, listened to everything that was said, and the headlines that came after completely disconnected. They'd missed it completely. They 100% missed it. I get why they missed it. It was on purpose. I get that because you're not going to get the clicks from it. Media is a business. I understand that. If I was in that business, I'd probably do the same thing. But the investors have not yet really digested what happened this week.
Well, the markets responded to Kevin Warsh's first press conference in a very similar way that they have responded to previous Fed chairs' initial meetings. It's the same thing. If you go back multiple Fed chairs, the market always kind of dumps on the first day, the first chair that they lead, essentially, the first meeting they lead, that the new chair leads. And so this followed suit. We saw a down day on the day the Federal Reserve, actually it was an up day before the Federal Reserve, because I remember I called you or texted you or something. I was like, wow, the market turned around quickly. But I guess it should have been something that we expected based on historical norms. But so what actually happened at the meeting was the Federal Reserve held rates steady. No real surprise there. Everyone was expecting it. The shift, what we had there was the messaging, updated projections from the officials, which we'll talk about in a minute in this context. But those Fed officials expected rates to end higher in 2026 than they are today. Again, this is 9 out of 18 officials forecast at least one hike this year, according to the dot plot, what's called the dot plot. And we'll explain kind of what the dot plot is. Actually, if you want to do that, can you explain what the dot plot is for anybody who may be unfamiliar?
Yeah. So pick a number 1 through 3.
2.5.
Why did you have to put a decimal?
2.
Okay.
1 through 3.
Yeah.
Okay. Yeah.
So you pick 2.
Sure.
I'll pick 3. 3 plus 2 is 5. Divided by 2 is 2.5. That's the dot plot.
Well, I said 2.5.
Well, but now I'd have to do 2.5, and I have to say, what am I going to do? And then it's like, okay, 3.625.
Yeah, okay.
So that's the dot plot. The dot plot is out of the 19 voting members, they all just guess. Where would you think interest rates would be at the end of the year? And then, so 9 of them had it a little higher than where it is now, and 9 of them had it a little lower, with the Fed chair, whose bias is to lower rates, abstaining, which means that if the vote were held today, there would be a cut, because it would be 10 versus 9. But that's the dot plot. You just take the numbers, add it together, and they average it all out and say, this is where we think we're going to be. It's just... It's
an invention of Bernanke. He introduced it in 2012. So prior to that, it didn't exist. It's fairly modern development as a broader push toward transparency from the Federal Reserve. And this is sort of the hallmark of the post-Bernanke Federal Reserve, is this hallmark of transparency and communications. And that's what we've been used to with, Bernanke, with Powell, with Yellen. They all kind of followed suit there. So that's what we're saying is the shift. Because for quite some time, the market has been trained to read the dots from the dot plot. And not just the dots, they look at the Fed meetings, they look at the conferences, they look at the forecast, the forward guidance. So you got a lot of people that trade on that information, and we might not be doing that. I mean, not us, but they might not be doing that in the future, is the basic takeaway.
Yes. It's a big deal to get rid of the dot plot, because monetary policy isn't supposed to be a guessing game, even though we know technically it is, but it's like the best informed guess by those that are supposed to be that are freed from all worldly possessions other than to use their brain for the good of the economy in the country, right? It's like you make the decisions, you have 500 PhDs.
Well, the other issue is that the decisions that you make is only as good as the information you have. And we know that the information the Federal Reserve leans toward to make their decision is largely stale by the time they're making those decisions. That's why you have, we've talked about truflation on here a lot, but they track that inflation measurement in real time. I think they're like 1.6, 1.7 now. I mean, they are
I have it right here.
They are saying that inflation is below the Fed's target. And then when you hear the Fed talk, they're saying it's not below the target. And so difference there is the data they're looking at. Trueflation is looking at real-time data to make those, to inform that kind of narrative, and the Federal Reserve is just not.
Well, so go back to the dot plot first. You're right that it is, markets are going to have to get used of trying to expect what the reaction function of the Federal Reserve is going to be. And then kind of in an opaque way, Kevin Warsh is saying, you need to rethink what our reaction function even will be, and whether or not we're going to be reactive or we're going to be proactive. Those are two very different dynamics. So if we take a step back and when we see a reduction in Fed communication, we see a reduction in forecast, it does remind me again of Greenspan. And I said that his approach is going to look more like the 1990s productivity boom that was managed under Greenspan than the post-2008 GFC, Great Financial Crisis, where, there was super amount of communication, super amount of involvement in the private market, specifically with the expansion of the Fed's balance sheet. And Bernanke and Powell, very communicative, constantly. The Fed governor's always talking, giving opinions on everything. And that drove markets for better or for worse. But Greenspan was famously and deliberately opaque. And the market then had to say, we need to do the hard work for price discovery. We need to do the hard work to pay attention to the data that is publicly and privately available to us, to read the economy itself, rather than the Fed trying to read the economy and then the Fed reacting and then the market reacting to what the Fed did. The market just needs to pay attention to the economy. And that in and of itself will give the Federal Reserve more data to act in a manner that is conducive with its dual mandates and for the greater benefit of the people. So I think that reduction of communication, I'm a huge fan of, because it's one thing to have a collaborative effort and access to all of the data within the economy that the Fed has, and then try to make decisions in a collaborative manner based on that data. That is much different than every Friday a Fed governor having an interview with CNBC or with Fox Business or Yahoo Finance and giving their individual opinion, on something that's happening. And then, so you'll have the San Francisco Fed governor say one thing, and then the Chicago Fed governor will say something completely different. And that stuff should really be deliberated in private for them to come to an academic and professional consensus, rather than one saying we should cut, one saying we should raise, one saying we should do this and the other. And then it's like,
because there's no single decision maker. It's a
collaborative
consensus.
It's a collaborative effort. Correct.
Yeah. So it could mislead potentially. But if you look at pre-Bernanke, the Fed chair didn't have press conferences after every meeting.
No.
The market, to your point, had to figure out what the Fed's intentions were, but it wasn't explicitly told to them. We didn't have Federal Reserve chairman coming out and talking about the valuations of the market, which
and they shouldn't.
It was such an absurd thing. That's why we talked about it a lot here on this show.
Yeah, the Fed, for all of its criticism, from its creation to its mistakes to its successes.
Creature from Jekyll Island.
Creature from Jekyll Island is a good book. It's a very big book, but one to read. The most intelligent thing it's done is to be quiet enough that the American public does not realize there is a committee of people that are not elected by you that set the most important price of all, which is the price of money. So we have price fixing, just like when you think about the old USSR price committees on what's the price of corn and soybeans.
I mean, that's not a new development.
This stuff's going to be, but the American people don't really realize it, and it's worked out really well because the Fed has been an important player in the modern financial system. But if I were them, I wouldn't want to be on publicity tours every single week and giving mixed messages, and there's competition between the governors. It's like, do what you do best, and they are a great institution. There is no arguing with that. So I think it's a good thing. And I wouldn't be surprised if the majority of the 19 voting members agree with Kevin Warsh that we probably need to shift a little bit of our language around. But, so that is not their job. Their job is not to talk our ears off and make people have panic attacks every Friday at a business lunch and learn somewhere in a big city. So, but let's look about what their two official jobs actually are. Let's
have
recap
the dual mandate. We talk about this a lot too on the show, but dual mandate actually is keep inflation under control and keep employment strong. Now, under Powell, those two goals, or those two mandates rather, were treated roughly equally. So the Fed was constantly balancing sort of inflation risk and labor market risk, and it communicated that explicitly. So with Warsh, you are not seeing him abandon the dual mandate, but he is going to, he's going to reorder it a little bit.
Yeah, the price stability, he says, is the prerequisite for a healthy labor market, saying inflation is in fact a policy choice. That was echoing Milton Friedman, which was a mentor of his, stating if the Fed gets inflation right, the employment side takes care of itself. That's a fundamentally different posture than the recent era. It means the hurdle for the Fed to respond to labor market weakness is now higher, I would say. But how you interpret that, and this is where we're getting to the nuance, how you interpret that is a little...
Yeah, most people call it hawkish. That's what you saw in the news, is hawkish. And, in the short run, maybe they're not entirely wrong about that. Less forward guidance means more uncertainty, and the markets are going to have to figure that out. So there may be a period of time where it's going to be volatility, back to our term we use a lot. The adjustment policy is real. There's a whole generation of people that learn to trade on these Fed vibes that have been given off, and now we're going to have to figure out how to read the economy. And so that's going to be a real thing. But again, to balance the short and the long end of that, longer term, is that a better outcome?
I think this is where people are missing it, because on the surface, some of the things he said was very interesting in how you balance these dual mandates, and he believes genuinely that they are not in competition or contradiction to each other, which has kind of been the accepted reality over the past few decades. But really in how they source the data to determine if the labor market is weak, how they source the data to determine, is inflation out of control? Is it in imbalance? What tools can the Fed do to have a better element of price stability? Because that's really what he kept talking about, was price stability. And he spoke specifically about 5 task forces from communications, the balance sheet, data sources, productivity, jobs, and the inflation framework. And we spoke about trueflation. He recognized the outdated approach of how they even come up with the CPI anyway, and then how things are weighted, right? And he mentioned specifically, say, a gallon of milk or price of eggs. There is absolutely nothing that the Federal Reserve can do about the bird flu causing the price of eggs to go up, or the screw worm causing the price of beef to go up. The Fed cannot do anything about that. Those prices, if you have less chickens laying eggs, prices are going to go up for you to, if you really love eggs, you're still going to pay that price. But if you say, I actually don't want any eggs today because I'm not going to pay that, that creates an equilibrium of supply and demand, and it allows shortages to not occur. This is why you have shortages in price-controlled systems. When you think about the USSR, it's because there's no price signals for people to increase or decrease their consumption, their demand, and then supply cannot react to that accordingly. But he did say that, we can look and see if there are second and third order effects where inflation becomes really insidious. And so I think what we're going to be seeing as these task force play out, you're going to see the Fed is going to reach its 2% target primarily because they are going to change how the CPI is calculated, because they believe that they need to pay attention to a more balanced view of prices so they don't destroy the economy by raising interest rates. And you talk about trueflation, which he did not bring up, but I do know based on his commentary in the past, he believes that a trimmed mean version reduces noise and gives you a better outlook. If we were using a trimmed mean version on headline CPI today, instead of it being 4.1, it would have been 2.9.
And what would have been the large effect on that?
The large effect on it is the headline number wouldn't have been 4.1 or 4.2.
Due to what, though?
Because you're taking the trimmed mean is, let me make sure I get this exactly right. I had gone on in my tabs here, but it's used to calculate the central average after removing specific percentages of the highest and lowest value from the data set. So if you think about a standard distribution curve, your bell curve, it's removing out, say, everything outside of the first standard deviation, or so many percentages from the average.
You're targeting volatility.
Yes.
with that.
To look at where
Yes.
the actual average price of living outside of these few things is going.
Right.
So is your Netflix subscription going up by 10% on year? Yes. But did your car insurance go down 30%? Yes. So let's get rid of the noise
Or
and
did
look
oil
at the
spike
average.
in the short term?
Correct. That's
and does it
discounting.
have enough time to work its way into the
Correct.
overall averages?
Correct.
Yeah.
So a big fan of the trimmed mean. And then also in understanding that you can reduce inflation by reducing the balance sheet and actually still lower rates so that the housing market isn't restrictive while Wall Street gets easy money, right? And so spoke a lot about the balance sheet before he became Federal Reserve Chairman. It would not surprise me at all to see a decoupling of the Fed from certain market activities, that being used simultaneously with getting interest rates much lower, because you can cut the interest rates a lot and reduce housing expense, reduce borrowing cost for consumers, and make sure that that does not lead to inflation by simply reducing the Fed's balance sheet. Would not surprise me.
And potentially
to see
working
that
more
happen.
closely with the Treasury as well.
Yeah. And you think too, which we have here, where you have your 2-year inflation break-even expectations are now negative for the year.
Mm-hmm.
Tell us a little bit about that. And then it's going to give me a moment to clear these tabs up to make sure I'm on topic with.
Yeah, so
as we go from
two-year inflation break-even expectations started the year around 2.3%, and they spiked around 3.3 at the height of this conflict back in March. And now they've fallen back to 2.2, which is below where they started. So the bond market here is saying, we don't believe that this inflation is going to stick around. And then you look again at the 5-year forward, which is what the Federal Reserve actually used to use, about what the bond market thinks the rates might be, or the bond market thinks inflation rather than rates will be 5 to 10 years from now. That is sitting at 2.1% right now. So it's right in line with the Fed's target, maybe a little above it.
Yeah, the 5-year expectation's at 2.1.
Yeah. So the bond market, when it looks out past this near-term noise that we're experiencing, is not worried about sustained inflation. And that is a signal that you have to pay attention to. And why people are not paying attention to it, I don't know. Maybe it goes back to this whole transparency thing and the changing of how people, look at the Fed vibes, which is a great term. I saw that somewhere. It's not mine, but Fed vibes is a great term. People trade on the Fed vibes, and they can't do that. They're not going to be able to do that going forward. They're going to have to actually look at the data behind everything.
Yeah, which reinforces long-term investors, savers in your 401k, IRA, savers that are using structurally developed, data-dependent portfolio management through advisors, through their trusted advisors. You're going to be able to have a higher degree of confidence, and you're not going to be able to these headlines specifically around Fed actions are going to become far and few between, because there's not going to be any data coming from the Fed. And so markets, instead of trying to take advantage of the emotional ups and downs and the algorithmic trading and the computer driven, the AI models that float around every time a Fed person speaks, that's not going to exist anymore. Or it's only going to exist in a very small part. So yeah, you're seeing the bond market telling you where they believe inflation's going. That does comport with, mesh with the productivity, technological productivity that generally reduces inflation, is a very powerful deflationary force that is going to kind of dominate the next decade or two, where you're going to have the Fed be a little easier than what you would think they would be able to be, and get the cost of things down without, having what happened in COVID. And what happened with COVID, everyone understands, was, an anomaly. It really was. It was a
black swan.
It was a war-driven response to a war-like event, and that created dynamic changes. But we're going to get back to, and we're back to business as usual. They will inflate the money at 2% a year, which means if you have $1 million in 10 years, you have $800,000 in purchasing power. In 20 years, you have $600,000 in purchasing power. So 2%, if you're worried about inflation, you need to understand 2% is going to happen. It's going to happen every year. Some years maybe 2.5, some years maybe 1.5. But it's going to occur, and that's when you need to have a good, strong plan to grow and compound your wealth. And just I guess, take a deep breath, because the media is going to have less meat to chew on in terrifying the public every time somebody at the Federal Reserve says something, because they're going to be saying a lot less. And that'll lead to probably to some healthier sector rotation, honestly, because...
Well, it's certainly going to... it's certainly going to enable us to look at what the Federal Reserve is doing and compare that against what the market is doing also, like individually, separately. So currently you talked about industrials, which is a great kind of segue into this, but industrials are telling a story, small caps are telling a story, financials have been leading the market. All of these kind of sectors that have been underperforming are now starting to turn that around. And you're getting signals, like we got this week with, we have a gold position that we've had in 2023. We got a sell signal on that this week. So all of these things go to, at least in my mind, say that those sectors don't lead when investors are worried about persistent inflation. They generally lead when investors are expecting an underlying economy to be healthier or maybe, experiencing some growth specifically on the equity side. So it'd be interesting to see if that does come to fruition and it does match up with what the Federal Reserve is saying, because we're seeing the signs there. With the bond market, you're seeing the signs in the sectors that are supposed to behave the way they're going to behave when you're should expect growth to come. Now, obviously, we don't have a crystal ball. This is not a guarantee. There could be something that comes along and changes that. But just at the face value of what you're looking at, when you're looking at these metrics that people have used to trade on long before the dot plots and the Federal Reserve chairman spoke every time they met, these are kind of agreeing. All of these things are agreeing. And we like to see that. We like to see various data points kind of all saying the same general consensus.
Yeah, it's very interesting. The gold signals are interesting as we, continue to digest those over the weekend and verify that data. It'll probably lead to an underweight on gold, which is not a bad thing, because it's telling you that bit of data that we've been getting over the past few days is telling you where inflation expectations are going, and they're coming down. And if what I'm seeing with even with the massive AI build out and how much CapEx is being spent, we know that the standard $30 a month or whatever to these LLMs, the real cost is probably $3,000 a month for them to provide you with that service. Even with that great disparity right now, as this stuff's getting built out, the price competition per token is going down between the competitors, even with their losing money. And that's probably because they know where the convergence is going to happen as this build out continues to grow, and they're able to scale token issuance through these AI models. Supply, you run the risk of supply significantly outstripping demand. So you're going to have price compression and the rate of collapse in that price, which directly correlates to how affordable it is for small businesses and mid-sized businesses to use those products in order to drive efficiency and lower their cost, is going to be pretty significant. That's deflationary. So yeah, short-term communication change introduces uncertainty. It's uncertainty that I like, and markets are going to have to adjust and do the hard work of quit paying attention to what the Federal Reserve says and start paying attention to how much money Apple is making, how much money Google is making, which companies are, what's the average earnings within the S&P, what's our growth rate, what's our GDP doing, what are these deflationary trends. Do the hard work, and it'll be a pretty good blow to these short-term algorithmic traders that just take advantage of people's emotions every time one of these press conferences happen. And I'm very happy to see that change materialize, hopefully over a period of time, the Fed getting quieter, and the bond market being the bond market getting back to, which is what Greenspan would say. He paid very close attention to what the bond market was doing. That's what led him to help, in his role, help guide the other governors and the voting members of the FOMC to make the decisions they made, which produced significantly great outcomes, is let the bond market do some of the work for you. And let's figure out what's going on, because we are ultimately, our economy is driven by the private sector. not a central command and control economy. So I think it's the right outcome for sure. And consumers don't seem to be paying attention to any of this stuff.
Yeah, we'll hit two quick ones before we get to the planning room, which is going to be another longer kind of conversation. But consumer spending, retail sales rose 0.9% in May, nearly double what was expected, and up 6.9% from a year ago. If you strip out the most volatile categories, the underlying pace of spending was up 0.7%. So the consumer is still in the game despite the higher fuel costs we talked about, the inflation pressures that brings, and that's a pretty meaningful data point as well.
Yeah, I would say so. And of course, SpaceX company went public last week, raised about $75 billion, the largest IPO in history. Shares jumped 90% on the first trading day, valuing it roughly at $1.77 trillion. It did hit $2.7 trillion, or actually $3 trillion at one point during the day. So a pretty significant IPO. Shares, if you were able to get them, was at 135. We hit 220. So almost not quite a doubling, but pretty significant, giant increase. If you think about the increase in market cap from IPO price to its highest trading price this week, you're talking about like the combined value of like the lower 300 of the Fortune 300 companies.
Yeah.
Just in a few days.
We only hit 201, I think was the high.
I think there was an intraday price that it briefly surpassed Microsoft's market cap.
I don't think so. 201.80 is the high.
Let's see.
I didn't think it. I remembered getting that high.
Let's see.
Oh, maybe you're right. Yeah. Wait. 222. Yeah.
Yep, there it is. Yep, 222.
You are right. You got to zoom in on these things.
You got to zoom in. Sometimes you got to zoom out and
That's
zoom
wild.
Zoom in. But that's what we're going to talk about in the planning room, because we've been fielding questions about it all week, and they're wonderful questions, wonderful conversations to engage in, because it's such an interesting topic. Space exploration, the untold trillions of dollars of opportunity. It's out there. We're thinking on the frontier again as a country, kind of, when you watch documentaries, about Kennedy and the space race and all of those things, it's very interesting. If you've watched the Apple show For All Mankind,
didn't watch that.
That's like an alternate history sci-fi show. Very interesting. It's very exciting to people. There'll be IPO talks about OpenAI and Anthropic that are preparing to go public. And should you try to get in? And the answer is a lot more subtle and it's a lot more nuanced. Maybe it's not subtle, but it is more nuanced than the headlines.
Is anything we do subtle?
Suggest. So here we go. Welcome to the planning room. So this week's topic, if you couldn't
Pivot
guess,
to the planning room,
is directly from conversations we've been having with clients and prospects during the past week or two. SpaceX completed the IPO, which again was the largest. We have OpenAI and Anthropic that's going to be doing it probably towards the year end.
Anthropic is Claude.
Claude, yes. So the question is, how do we get in on it? How do we get in on the action?
Yeah, it's an understandable question. Genuinely extraordinary companies. The excitement around them is real. People want to be involved. FOMO is real here. We want to give you a framework through thinking the framework we want to give is going to allow you to think through that more clearly, because the answer isn't just ignore it, and the answer isn't buy everything that comes out. There's like you said, there's a nuance between it.
There is, and you have to figure out, okay, what is an IPO, right? It's an initial public offering. And a lot of people have a surface level understanding of it, which is great. Some don't fully capture how that process works and how you get access to it and whether or not you should hit the buy button on day one.
Yeah, so the IPO is the moment a private company sells shares to the public for the first time. So before the IPO, you have institutional investors, you have early employees, you have venture capitalists. They own shares, private shares in this company. You can get private shares. There's Barron funds that have some SpaceX private shares. They have X private shares. They have other companies. I mean, there's not just Elon companies, but other companies.
There's a few out there that far and few between, and they're generally very diluted. So if we think about the Barron Partners Fund at the time, for every dollar in, say 10 cent was kind of or not 10. Yeah, for every dollar, 10 cent, maybe 10% or 8, depending on what time of the year.
Small percentages.
Small percentages, which generally is not what people are looking for.
Yeah, the IPOs and regular investors, like people who listen to this show, clients that we have, they get their first chance to buy it.
Yeah, because if you're not working for the company or being gifted shares as part of your compensation package, the only way you can attempt to buy those shares is to be an accredited investor or an institutional investor. The overwhelming majority of people do not qualify for that. Generally over $300,000 in income for each of the last 3 years and or a net worth outside of your home of at least $1 million. And there can be some nuance with that as well. And then once that's done, you have to find somebody to actually sell you the shares.
Yeah.
It's not easy to do, especially for companies like SpaceX. So that brings it to once it IPOs, and when the IPO happens, the day it starts trading is not when the company is issuing those shares. You subscribe to the IPO. This was 300% oversubscribed. People that get access to it first are generally going to be large institutional firms for their funds. So that's going to be U.S., European, Middle East funds, hedge funds, family offices. And then it gets rolled on down to more of your high net worth clientele. And, we had a couple people that did subscribe to IPOs on like Robinhood.
Mm-hmm.
They got like 1 share, 2 shares. So there's a handful
I mean,
of
I know people that
got some.
Yeah, I know people that got a decent portion of what they wanted.
Yeah.
But it was through Robinhood or through Schwab is another people I've got. Yeah. I've seen that, but it's a process where you sign up early. So I think Robinhood IPO is actually open 60 to 90 days before the IPO. You can express interest in it.
So they're trying to democratize it a little bit. It honestly should, because it's really unfair the way that it is done. But the part that doesn't really get talked about enough is the first chance to buy for regular investors is rarely, it's not the first time shares have traded hands. By the time a company like SpaceX goes public, it's been valued, revalued, negotiated, and priced multiple times. And the largest banks on Wall Street and their biggest institutional clients are the ones really deciding that. So the price at the IPO is definitely not the ground floor. It's the price years after the private market, kind of determines what SpaceX should be worth. Because I like SpaceX. It's a cool company. It's a great story. You chart out on an Excel list everything they're trying to do, and you start thinking, okay, the what if scenarios. It's mind blowing, but it hasn't happened yet.
Yeah.
So that's something to consider. And that what did we start at? What was the IPO at?
135 is what it came out on. What happened next? What did it do?
Well, the shares jumped 19% on day one, which sounds great, but that 19% went to a lot of the people that were, institutional investors who was allocated shares, kind of at the IPO price. By the time a regular investor could buy it in the open market, the stock had already moved significantly. So you're already overpaying significantly. And one thing you have to understand, because we cautioned with this, as we have with other IPOs, first of all, it's going to be virtually impossible to get allocation. It's going to be impossible to get allocation at any meaningful amount. 10 shares, 15 shares, 20 shares, maybe. You're not getting $200,000. It's just not going to happen because that's already been decided to be allocated towards very large institutional players. What happens with IPOs generally is your first day you get a big pop. If you get IPO shares, you cannot sell them for a certain period of time. In this instance, it's 15 days. If you held private shares before the IPO, you cannot sell them for 6 months. Okay? Now, SpaceX can issue more shares between now and then, which would dilute existing shareholders for them to raise more capital, which is going to happen because the whole point of the IPO is SpaceX needs cash to execute on its business plan. To get the future growth, it has to have money today. So they're giving you a portion of the ownership of the company in exchange for cash, and they're going to take and spend that cash to try to achieve their hopes and dreams and create growth and value. So historically, first day, you're going to have a 20% pop. Now remember, if you got IPO shares, you can't sell, okay? So you just got to watch it. Watch what it does.
You can.
Not if you were allocated IPO. In most instances, it's 6 months. In this case, it's 15 days. You cannot, if you were on your Robinhood app, generally it's a 15-day lock. If you were allocated, not if you press the buy button when it opened at 135 and it went to 170, if you bought it at 170, yes, you can sell that. But if you got the 135 allocated IPO share, you can't sell it. Now, this is what's interesting. When you look at, and this is why we always say, and what the strategy that we're executing for our clients that are interested in having single stock exposure to SpaceX that have expressed interest, is to take a dollar cost averaging approach over time, when we feel like we're at a place where you're getting in at a good price over a period of time, that's not going to be tomorrow. It wasn't yesterday. It may not be next month, but it's going to be over time. A significantly large percentage of IPO shares over the last decade lost money on a rolling 36-month period for a certain period of year over that first year, or a 3-year period from the date of the IPO, 56% of them, actually. Now, you do have the top 10%. You have a high dispersion occurring where the top 10% did make money, but 2/3 after 3 years of IPOs underperformed the broader market. And it's because of these wild price swings. Only 4% of SpaceX became available to the public markets. Only 4%. 96% of those shares are not actually available. So the market cap of the company is being determined on just 4%. It would be equivalent to the housing market, say in the state of Kentucky, being determined purely by just 4% of the houses that are being sold. Well, if 4% of those houses or get caught up in a mania, you would look and say, oh my God, Kentucky has the most valuable real estate on planet Earth, but it's not reality because 96% of the houses haven't actually moved or they're not actually on the market. So you have a pop and drop, or what's called the first year effect, where first year losses are around 50% for most IPOs after the initial excitement fades. So we're encouraging those that are reaching out to get an allocation plan ready, kind of think about extra cash and things you want or how you want your portfolio to be readjusted over the next coming months. Definitely the first inflection point is 15 days after the IPO. The next inflection point is 6 months after the IPO. And then from there, technicals can be used to determine, prices I'm looking at that I'm paying attention to is in the 140s, in the 130s, and then whether or not we break 102, 103 on the downside. Those are kind of the 3 price inflection points that I'm looking at, not personal advice, and I'm not saying I'm going to act on what I'm looking at. Right. But from a topic of interest, I'm gonna pay attention to that, so that you can average in at a good price point and have a position to hold that you believe in, that you want to be a part of, because it is extremely interesting. And I've been watching this for years, and I think that it's gonna. I think over the next decade, it's gonna surprise to the upside more than people think. But you have to be smart about when you buy and not give in to the hype. And that's been our encouragement, is to take a very slow, methodical approach. Let's think about how much allocation we want. And over a period of time, we're going to execute on that for our clients to give them exposure for those that want it, to give them exposure, because not everybody wants it. And most people shouldn't have single stock exposure because it doesn't fit with their plan, right? It doesn't fit with what they need.
Could not. I mean, everybody's different.
Everybody is different. But I would just say that your general 401k investor is, it's probably good to not concern themselves with too much when it comes to single names. But for those that are seasoned investors,
they'll likely get exposure to it through an index.
That's right. They will. They will. But all that leading me to say is that if you are interested in it, reach out to us. And if it's something that you would like to have a small exposure to, that's fine. But it's also fine. You don't want to get caught up in what's called FOMO, the fear of missing out. That's perfectly fine too. But regardless, when it comes to these types of IPOs, I believe personally to take a very slow and steady wins the race.
A dollar cost averaging approach.
And a dollar cost averaging approach, and build a position that is responsible, diversified relative to your other positions, and work with a professional to determine how much weighting that should be. We've always said, as a good rule of thumb, 5%. Now, we have lots of clients, we have lots of investors that have a much higher risk tolerance to those things, and they may want to have a higher percentage. But a good default rule of thumb, if you're in retirement, is you want to have, if you have a concentrated position, you need to hold it for a specific period of time and have your profit, your take profit markers that you've discussed with your financial advisor. And then outside of those unique situations, a good 5% weighting is a good kind of ceiling. It's a good rule of thumb. Not advice, but a good way to think about it. Because when you're thinking about it, you may come to the conclusion that a 0% allocation is the right price. Right. Because there's going to be a lot of volatility with this name. You have the political implications of big firebrand CEOs, government contracts, fiscal implications. You have the reality that every time one of those rockets blows up on the launch pad, what do you think is going to happen to SpaceX stock the next day?
Yeah.
It's going to be down. And so that's why I said probably for your average 401k investors and those that have been disciplined in compounding their wealth through, managed strategies like what we do, it's not something they may want to ever have exposure to, and that's perfectly fine. Perfectly fine and reasonable. Makes a lot of sense.
All good things. I think that's a good place to wrap it up. We've gone a bit long, but we are looking at oil in the mid-70s for now. Fed chair with a new philosophy, largest IPO in history, and Middle East situation that hasn't resolved just yet, but maybe on the verge there. And, we talked about signal and noise and all that kind of good stuff. That's where we'll call it. That's been good returns for this week. We hope you've enjoyed it. Please share, subscribe if you find value in it. And we hope to have all good outcomes. We will see you back here next week. Or actually, we'll be virtual next week.
Yeah, we'll be virtual.
Either way.
Virtual.
Yeah,
I will
way.
be talking to you from Tampa next week.
Well, I'll be talking to you from here. Not here, but here,
Yes.
Anyway, that's been it.
Yeah, everybody
have a good
take
weekend.
care. Safe weekend, enjoyable weekend. MomentumWealth.us. If you have questions, reach out. Take care. That's
See you later. Bye-bye.
Yeah.